Prepaids and escrows, what are they? Everyone just says, hey, it's a payment that's being made through my mortgage to pay my taxes and insurance. But they really, as long as I've been doing this, I realized that my clients really don't understand. When I give them a payment and the taxes or insurance are included, then we're getting through the process. I say, okay, go get me the homeowner's insurance for the full year. They turn around to me and say, wait, I thought it was through the mortgage. Well, it is, but that's also considered a prepaid, meaning when you buy a house, you need to have the house insured right away from day one. You haven't made any mortgage payments, so there's no mortgage insurance payments being made. So you need to buy the full year of homeowner's insurance. So that's a prepaid. Prepaid. So in this example, we're going to use $1,200. Another prepaid is basically you close and the taxes are due for that quarter. Okay, so let's call the taxes $1,000 a month. Keeping simple numbers, that quarter, the quarter costs you $3,000. So that's $3,000. So and the other thing is days of interest. Every day that you close, there's a dollar amount to that day. We'll just call it a simple $100, just to keep the math simple. So if you close on the 5th day of the month, so that's 25 days times $100, that's an extra $2,500. If you close on the last day of the month, so one day, so it's $100 times 1 equals 100. It doesn't matter because it depends on the client and whenever the due date is. So for example, if your contract says you're going to close on the last day of the month, you're going to have to pay $100. If it says you're going to pay, close on the 15th, you're going to pay 15 days. So, but you also get access to your home faster. So in this example, let's say we close in the month of January. So January 5th, the client gets to go in the house in January 6th or the 5th, let's say. They won't make their first mortgage payment until March 1st. So if you close on January 31st, for example, you're still making your first payment in March 1st, but you only have access to your home for 30 days. So the bank is always collecting interest up front. So let's keep this example, with your prepaids being in this example, 42 plus 2,500, we're going to call that 6,700 in your prepaids. Now, your escrow. When you close, you'll also have an escrow account set up. And what is this account? You'll have access to it in your mortgage statement every month. You'll see a balance and you'll see the monies going into it and being taken out, being paid for homeowner's insurance, for example, the following year when it's due. You'll be seeing your taxes being paid every quarter if it's due every quarter, or in some cases, in certain states like Florida, it's paid once a year. So it'll be done that way. So in this example, let's say we close in January. Our first mortgage payment won't be until March. But the quarter is due in April. So when you go, you're going to collect 2 months worth of homeowner's insurance for $200. And then you're going to collect 2 months worth of taxes for $2,000. So you're going to set up an escrow account with $2,200. Now, the $200 is here. As you keep on making payments starting in March, that will be 10 payments. There's your $200. You're going to make $1,000. That'll be your $1,200. When the first of the year comes, that insurance payment is made. Now, for your quarterly payment, you have $2,000 in there. You're going to make your mortgage payment in March. It's going to go into the account. You're going to add $1,000, and that quarter is going to be sent out for $3,000. Then you'll be at zero. Then your next payment, your taxes are being made through your mortgage payment. $1,000 will go in there, and so on until it comes out. If you have any questions in regards to prepaids or escrows, please give me a call.